Welcome to this explainer. Today, we're diving into some incredible research that might just completely transform how you view the global economy. Most of the time, international trade and finance are presented as this simple collection of static ledgers, just isolated countries keeping track of their own imports and exports. But we're leaving that outdated textbook view in the dust. Instead, we're going to decode the global economy as a cutting-edge, dynamic mathematical network where systemic risk actually acts like a physical force.
So, think about this for a second. What actually happens when the global economy is treated as a math equation just waiting to break? Well, as we'll discover, global financial crashes aren't just isolated accidents or strings of incredibly bad luck. They are actually predictable, topological phase transitions happening within a massive, fragile web. Seriously, once you see the math behind the money, the world is going to look completely different to you.
Here is our roadmap for today. First, we'll decode the balance of payments. Second, we'll tackle the twin deficits hypothesis. Third, we're mapping the global economic network. Fourth, we'll look at fragility and tipping points. Fifth, we'll explain Triffin's dilemma. And finally, number 6, rewiring the global economy. All right, let's jump right in. Section 1, decoding balance of payments. Okay, before we get into the really complex network math, we need to understand the raw data feeding it. So let's explore the basic checkbook that every country uses to track its money. There are essentially two halves to this national checkbook. On one side, we've got the current account. This tracks what a country buys and sells in the current period. We're talking exported merchandise, imported software services, income from investments, that sort of thing. Now, on the flip side is the capital account. This tracks the ownership of global assets, logging the flow of capital, foreign direct investment, and debt liabilities. Put simply, the current account is all about income, while the capital account is all about the transfer of asset ownership.
To see what this actually looks like in the real world, let's look at India. Between 2011 and 2012, India recorded a massive current account deficit of exactly 3,760 billion rupees. As the official data notes, this substantial widening reflected a very distinct growth asymmetry between India and the rest of the world. Basically, imports far outpaced exports, meaning India was buying significantly more on the global market than it was selling.
Moving on to Section 2, the twin deficits hypothesis. Let's see how this builds, because a country's internal budget has a direct theoretical link to its international trade. It's a really fascinating concept that connects domestic politics straight to the global stage.
And this brings us to the twin deficits hypothesis. This is the macroeconomic observation that a nation's government budget deficit often leads directly to a current account or trade deficit. They act like twins. And why is that? Well, when a government spends more than it taxes, it obviously has to borrow. And if the domestic citizens just aren't saving enough to fund that borrowing, that money literally has to come from foreigners.
The absolutely crucial point is captured perfectly in the math here. The current account, or CA, equals private saving minus investment plus taxes minus government expenditure. So if government expenditure drastically outpaces the taxes collected and domestic savings just remain static, the trade deficit is mathematically forced to absorb the difference. Now, this traditional view treats the nation as this isolated unit that just interacts broadly with the rest of the world.
Which brings us to Section 3, the global economic network. Now, we are going to totally pull the rug out and shift the paradigm here. We are leaving behind that traditional, isolated view of national economics. Because, let's be real, the rest of the world isn't just a single uniform entity.
As the absolute latest mathematical research highlights, global imbalances are jointly realized on a directed, weighted network of cross-border current account and financial claims. This changes our perspective completely. These supposedly isolated national ledgers actually form a massive, directed mathematical graph. So, global imbalances aren't independent at all. They're deeply linked. And within this complex web, systemic risk is lurking right there in the spectral gaps, the hidden mathematical spaces between these actual connections.
What's really fascinating here is that a country's deficit only becomes systemically dangerous depending entirely on its location within this global web. We can map this by translating accounts into a topology. Sovereign countries become nodes, and net bilateral flows become directed edges. Researchers use an incredibly complex tool called a non-negative exposure lift just to map out who actually holds the claims over whom. And then there's the spectral radius. This is a massive mathematical value that determines exactly how intensely an economic shock will ripple across the entire planet.
All right, Section 4, fragility and tipping points. As we map out this complex web, we can actually move from simply describing the network to predicting its failure. We can literally calculate the exact mathematical tipping point of a global financial collapse.
Let's take a look at the math of a collapse. When you map this out, a distinct curve emerges. As the network's spectral radius approaches the value of 1, the entire system enters a regime of systemic fragility. This is a phase transition known in physics as critical slowing down. What this means in plain English is that the global economy's ability to absorb economic shocks drops to practically zero. A localized shock that would normally just dissipate instead persists infinitely. It cascades through bank accounts and supply chains everywhere, dragging the whole system down with it.
But to accurately trace how these financial shocks actually propagate, we really have to ignore the bilateral noise. Imagine money flowing from, say, node I to node J. A valid systemic flow continues onward to a new node, node K. What we explicitly forbid in our mathematical modeling is the immediate reversal of the flow. So no money just bouncing right back from J to I. That doesn't spread the shock.
To achieve this, researchers use what's called the Hashimoto non-backtracking constraint. It's genuinely amazing that this specific equation acts as a mathematical filter to predict disaster. It essentially proves that global sovereign debt contagion happens specifically when imbalances are rerouted forward through alternative chains. By preventing the math from getting stuck in a simple two-country loop, we isolate the deep network circulation that actually causes a global phase transition, the exact moment where the whole web just shatters.
Moving to Section 5, Triffin's Dilemma explained. Let's inject some structural tension into our newly mapped network. Let's look at the central player, the country that prints the global reserve currency, which historically is the United States.
This naturally leads us to Triffin's dilemma. Now, while traditionally viewed as just an economic theory, in this context, it's actually a topological fact. The issuer of the reserve currency has to supply global liquidity by running external deficits, and this turns them into a massive central node, absorbing all these incoming claims. Now, on one hand, this improves global connectivity, everyone can trade smoothly, but simultaneously, it mathematically increases the dominant spectral scale of the whole planet. By being the center of everything, they virtually guarantee that any shock they experience is amplified globally, to the absolute highest possible degree.
Now, you might be thinking, well, let's just use multiple reserve currencies to spread the risk out. But if we try to fix this by adding multiple competing reserve currencies, essentially moving to a multipolar world, the network geometry actually becomes even more fragile. It creates a multi-core network, which reduces the spectral separation between these central nodes. Essentially, the feedback loops between the rival financial centers just intensify, and that actually increases systemic instability. Counterintuitive, right?
Finally, Section 6, Rewiring the Global Economy. We've seen exactly how the math breaks down and how the network shatters, so let's explore how a modernized global clearing union could essentially rewrite global policy to prevent this kind of collapse.
Instead of relying on slow, ad hoc political bargaining, policymakers could literally use this exact graph theory for spectral network control. Step 1. Identify the specific edges, those are the bilateral trade links, with the highest marginal systemic impact. Step 2. Apply a precise network tax or capital surcharge directly to these exact superspreader links to cool them down. Step 3. Target global liquidity to sustain the healthy, forward-moving paths. This mathematical approach prevents the directed recycling core of the global economy from just fragmenting entirely.
I'm going to leave you with this final, provocative thought. If global financial collapse is merely a mathematical phase transition, a predictable shift in spectral topology, are we actually prepared to regulate our multipolar world as the fragile, interconnected web it truly is? It really is time to look beyond isolated national deficits and start managing the mathematical reality of our shared economic network. Thank you so much for joining me on this explainer. Keep questioning, and as always, keep looking at the bigger picture.